The method is like this, that the question will be picked up by Sabir, followed by Anup, in a manner they want to pick up the chapter. If a question requires any supplementation by the respective printers, they may there won't be any broad questions during the answers, because from the same chapter there may be multiple questions on the subject and they may be answered subsequently. So only after the brain trust session is over, if there is a time left, then we will consider answering those questions. So you may write down your questions during the response session. With that, may I request Alice to take the proceedings.
Good afternoon, friends. First, I will introduce Mr. Anup Shah. He is a fellow member of the institute. He held 19th rank in the finance CA and 11th rank with distinction in inter-CA. He is also a law graduate from Mumbai University. Apart from doing BCom and also doing business consultancy study services from Jamnamal Prasad Institute. He has hands-on experience in business restructuring, capital markets regulations, foreign investment, international tax, PE investment, real estate structuring, valuation, advisory, etc. He has authored various books. He is author or co-author various books. Handbook on Capital Market Regulations, published by ICAI. Wills, Succession and Family Settlement, Law and Business, Income Tax Advisor, and has contributed various articles, papers in various magazines. He has also delivered various lectures. He is a faculty for Guru, RRC, and various seminars and various organizations. He is a director, independent director in Ruby Mills Limited, Very Life Science, Jacob Limited. He is a member of the National Committee on Financial Market, member of Direct Tax Committee of the Indian Merchant Chambers. He is a convener of the Journal Committee of the Bombay Chartered Accountant Journal, and he is also a member of the International Taxation Committee of Chamber of Tax Consultants. With these few words, I present before you Mr. Anup Shah. As regards Mr. Sabir Motalwala, I think we had a session last year, so yesterday on FTI. So I skip his introduction and I straight away request Mr. Yatin Desai to hand over a memento first to Mr. Sabir Motalwala. To Mr. Anup Shah. Floor is yours.
Friends, small brief. You had HITESH GAJARIA as one of the brain trustee and Anup Shah as the brain trustee. However, HITESH is not keeping good health for the last couple of days, and therefore he requested us and we have Sabir Motalwala for. But let me tell you that most of the HITESH brief is prepared by Sabir. So we have a horse's mouth also with us in terms of HITESH GAJARIA. So you will not find any regret or anything once you have concluded this great session. With that, I hand over the mic to Anup to start with the case studies, and he is considering the important case studies first. Therefore, we are on page number 7 from here to start. Yeah.
Sorry, page numbers may change because I got my answers here. So it's foreign investment which I'm starting with. So what we, Shabir Bhai and I have decided is we'll take FDI, ODI, immovable property in India, and then go on to the others which are not that important. Now, Paresh Bhai mentioned we're going to look at burning issues. Whether we're going to provide any water for them is a different question, or we're going to add more fuel to them. So that's up to you to decide. But we want to give our view on it. And in FEMA, as you would have seen in the last 3.5 days, there are no stock answers for stock questions. There may be issues on which you could have different interpretation and you could have controversial views also. So if you find our views a little not in sync with what you've been thinking so far, then please excuse us. So let's look at question. We're not going to be reading the questions, so we'll just directly plunge into the answers. So 4.1. Are other than that is, are FIIs and FVCIs eligible to invest in FDI? Answer is yes. There is no restriction that an FII or a registered portfolio investor or a foreign venture capital investor can only come in through the respective Schedule 2A or 6 or Schedule 3 for NRIs. They could also invest under Schedule 1 under the FDI route. The only condition is that the company receiving the investment as FDI must maintain an FCGPR, must go in for a valuation. And this is very important when you look at an FVCI. There is a foreign venture capital investor coming in under the FDI route. If you come in under Schedule 6, then you don't need to follow the DCF pricing method for an FVCI investing in an Indian company. It's a mutually acceptable pricing. That's one of the only instances where RBI has done away with valuation altogether. But if he comes in under Schedule 1, under the FDI route, then he needs to comply with the DCF pricing also. So FIIs, registered portfolio investors, FVCIs, all can invest under Schedule 1 as FDI. Next question is there a difference between portfolio investment from NRIs and FIIs? Answer is yes. Till a few months ago, FIIs came in under Schedule 2 and NRIs came in under Schedule 3. Now, since April, we have the registered foreign portfolio investor regime. What that has done is it has subsumed the FII, the qualified financial investors and the sub-accounts of FIIs all into one consolidated category called the registered foreign portfolio investor, and that comes in under Schedule 2A of FEMA. So they would all be eligible to come in under this schedule. All as an entire class put together can go up to 24%, which can be extended up to the sectoral cap, if any, of the company by passing a special resolution. So that is under registered foreign portfolio investor scheme. NRIs are not covered under the RFPI route. So they continue to come in under Schedule 3, and where the total can go up to 10% and individually 5%. So NRI separate and FIIs, QFIs and sub-accounts all separate. So yes, there is a difference between the two. Over to this.
Question 4.2 talks about Schedule 1 to Notification 20. Then it talks about one of the conditions there, investment is not made in Indian company to acquire shares of another company. Friends, before I actually go into the top-up questions, this particular proviso actually formed part of the original notification FEMA 20, and you know, when FEMA 20 came in 2000, even transfer of shares required FIPT approval. I think this proviso indirectly, was trying to prohibit that an Indian company with FDI, if it was trying to acquire shares of another company, then it was not permitted, because indirectly also it would mean it required FIPT approval. However, what has happened is, subsequent to a lot of interpretation with respect to downstream and incorporation of Press Note 2, 3, 4 of 2009, the substitution of this proviso is a mixture. It's not very happily worded. So apparently, it half continues what it was earlier, and the second half continues downstream investment may be permitted as per Regulation 14, which is in fact an enactment of Press Note 234 of 2009 into FEMA 20. So friends, we all know that there has been always a lagging behind and catch up between FDI policy and FEMA 20, and there have been various instances where the policy went in for a liberalization first, notification came in a bit later, again there has been some to and fro at 4 times. So I think this particular proviso is apparently one of the victims of such catch up and lagging behind. And really what one really needs to do is take a holistic view, because even in the RBI Master Circular, they've said that the FEMA notification needs to be read with the FDI policy. And whereas the FDI policy says that it is the edifice, the legal edifice is FEMA 20. So technically we'll have to actually marry the two and read two together, unless there is a severe conflict, in that sense, in terms of doing a harmonious interpretation. So I think that's the background, and then let's look at the question here. So the question is regulation 14 synonymous with downstream investment? Yes, to that extent the entire regulation 14 has been enacted to regulate the downstream investment, initially as intended under the FDI policy. Then they said government has not withdrawn press note 234 of 2009 with respect to direct and indirect investment. The consolidated policy does not provide for complete reconciliation. Can you explain the status of press note? Now, friends, again, what has happened here is that the consolidated FDI policy is nothing but an aggregation of policies and an aggregation of press notes. So there is no need to resign the old press note. Okay, ultimately what you get in the policy is things which have been prescribed by the press note 234. However, those press note itself have undergone some changes in the later consolidated policy. For example, initially there was a concept of operating cum holding company, pure holding company. So all that concepts have undergone change. Therefore, to a certain extent, if you now read the consolidated policy and if you read the original press note, you will find that there is a bit of difference between the two. But in substance, it only talks about computation mechanism. And I don't think there is any change in that substance and principle. If you apply that, there is no change. So I have personally not come across any case which will give me altogether a different result when I apply the current policy and the old press note. If there's anybody else who has come across, please let us know. At least that's my view. You really can't look at everything in that sense, because as I said, these press notes were also diluted. In the sense, some of the terminologies have undergone a change, and the recent consolidated policy reflects those changes. So you have to read those press notes 234 plus the later changes which came with the consolidated FDI policy, and the current policy stands the way it is. But at least I believe in principle it is the same policy and there is no change.
One substitution which I would like to make to this is that you need to draw a distinction between getting FDI for making an investment in another company and getting FDI for carrying out trading on the stock market. You cannot get FDI in a company for buying shares on the stock market. That is not permissible even with FIPP approval. And we tried several times with FIPP for JM Finance and other companies like Tata Investment Corporation, Chase Manhattan, all have unsuccessfully tried and failed. You cannot get FDI and say I want to use it for buying and selling shares on the stock market. But if you want to get FDI for investing in another company as a core investment company, that is permissible. So do draw that distinction when you are looking at getting shares, issuing shares for buying shares. Is it being done as a holding company activity, or are you going to buy shares on the stock market? If it's on the stock market, you can't do it even with FIPP approval, because that is looked upon as not falling under the financial service sector. Although under the RBI Act it is treated as an NBFC activity, for FEMA it is not treated as a non-banking financial service activity.
That will be with FIPP approval. Even investment is...
Even with FIPP approval, buying shares on the stock market?
CIC making investment...
CIC, yes, that is with FIPP approval. Now 4.3, investment in real estate sector. Real estate sector has the maximum real issues, and therefore we want a host of them. Now first is, what happens if the non-resident is unable to bring in the full amount? Now you have the minimum capitalization norms of $10 million or $5 million, depending upon whether it's a wholly owned subsidiary or a JV, etc. What if you cannot bring in the full amount, or there is a delay? Now here you can apply to FIPP for condonation of delay. They have a stated policy of not waiving the minimum capitalization norms or to not condone delay, because this is what they have said in one of their reviews, is that if we give a waiver, it amounts to tantamounts to dilution of the press notes and to opening the floodgates for waiver. Therefore, as a policy, they don't permit, but on a case-by-case basis, they have diluted. For instance, in Strawberry Constructions or Mundus Margova, or latest being Luxora Realtors, they did allow the investment to be brought in stages even beyond the minimum time frame. And in big malls, Delhi, here it was a case where they were not able to bring in funding, and they said we have undeveloped plots and we want to sell it on as-is where is basis. So your FIPP did not permit it because they said that tantamount to waiving the press notes altogether, and therefore they did not permit it. So they would allow waiver in a very exceptional, extraneous circumstance if you can make out a clear-cut case. Otherwise, they don't allow you to waiver in bringing the minimum capitalization norm. What if the project is not progressing due to regulatory or other reasons, not predicted at the time of making the investment? Here again, only recourse for you is to go to FIPP. Don't do anything on your own accord. Please apply to FIPP. If they feel, they will allow an exit. Recently in DLF Limitless, they were not able to bring in the money and hence they could not even buy the land. So forget starting the project, they did not even buy the land. FIPP did allow repatriation of the capital because they felt there is a genuine problem. So where they have looked at genuine problems, they have been considerate in that respect. Due to unpredicted reasons, the area developed is less than 50,000 square meters built up area. Again, same. Economic conditions, the gestation period has truncated to lower than 3 years. So answer to all is apply to FIPP. But this is an interesting one. If repatriation cannot be considered before 3 years, does it mean that the project cannot even be sold if it is ready before the end of 3 years? No, definitely not. All that it is saying is that you cannot repatriate the money back to the investor. You can make money. The embargo is not on selling the land or selling the property. Embargo is on repatriating the profits from the sale of this property to the NR investor. If FIPP gives permission, whether RBI is competent to compound the matter, yes, compounding is possible and RBI is the only authority to compound it. But if FIPP has given an approval, then generally compounding may not be required unless in some cases while permitting they have said to go in for compounding also. So like in Mundus Real Estate Goa, they allowed waiver of the minimum capitalization norms, but they said because you have made a violation under FEMA, please go and apply for compounding from RBI, but we are allowing you to give a delayed minimum capitalization filing. So it all depends on how the permission pans through. What is the meaning of the term project? Can it be construction on 2 different lands owned by one entity? Now there is no clear-cut definition of the term project, but it should generally mean project at one specific site. Even an integrated township could be a project. But then if it's an integrated township, it should be either you have a contiguous city survey number or you have one continuous land which is one land parcel. You can't have one in Thana and one in Goregaon and call that as a project. But if you have something which is adjacent to each other, even though they are developed a little bit apart from each other and in between I have common area, it all depends upon how as a commercial man would you view it. Would you view it as a project or would you view it as 2 separate projects? Also, your branding activities, your layout plans, your BMC sanctions, all that would throw light on whether you are looking at this as one project. Is there a common branding? Are you talking about it as one integrated project or are you saying 2 different projects? So you look at it as a general,
Do we take projects as per the contract basis? Can we define them as per the per contract basis?
I didn't follow. Could you clarify what's your question?
Suggesting is, can we make a project as per a contract basis? For example, I have a contract to develop 3 projects in one contract. So one site where I'm developing a project, another site who I'm developing another project, they are all considered under one contract. Can that one contract project and 3 projects in a single project definition?
If it is one project, that's what I'm saying. Commercially, how are you branding it? Are you like phase 1? Like there are some phase 1, phase 1, phase 2. Then it's yes. Then there could be a project.
Different sites, what he says.
At the same site, huh? At the same phase 1 would be at the same site only. Then it's not phase wise. No? Are you saying at different sites?
Different sites and different phases.
But in the same location. Again, my example of one at Goregaon and one in Thane is not phase 1, phase 2. I am looking at one at Goregaon which is phase 1, phase 2, phase 3. See, you can't have different, one located here and one located there. That's not a project.
But let's say I have a contract which says I will be developing 3 residential colonies, one in Goregaon.
No. Who would give you such a development agreement, 1 here, 1 there, 1 there? Normally with a landowner it would, unless you are a contractor, then this press note only does not apply to you. See, if you are an L&T which is constructing a building, then press note 2 of 2005 doesn't apply to you. It's only to a builder who is taking interest, who has a skin in the real estate project. He is the one who this applies to. And there is an FIPP decision in Supreme Infrastructure also that this does not apply to a contractor or a works contractor. Whether FDI in an existing construction project can be considered. This is a very vexed issue. Can you get onto a moving train? That's the question. Or do I need to get onto a train which is yet at the hangar? Now here there are two ways of looking at it. The funds need to be brought in within 6 months of commencement of business. Now if business has already commenced 6 months ago and development has started, and now if I bring in, how am I complying with this condition? Or look at a scenario where 80%, 85% of the project is already completed and it is only 10% finishing left. Now am I coming in to the project? Would this be not, can this amount to trading in real estate? Would it be treated as a real estate business? On the other hand, I have only 20-30% of the project which I have completed, and there's a long way to go. And even for development of infrastructure, even for development of the building, I need funds. Should I not be allowed to tap the FDI route? So I think you need to balance it between the two scenarios. Principally, if there is substantial work pending, I think you should be allowed to get into an existing project. But if it is just finishing or the end of it, it may be difficult. Hence, the better course in this would be to go to FIPP for permission and not test it on an automatic route. I know it delays the process, but I think that's better than taking a call on this because there's no express clarity on that. Can repatriation be made if 3 years lock-in is completed but 50% of the project is not developed? This has been one of the biggest issues till recently. Till now we always took the view, or several people took the view, that if 3 years lock-in is completed but 50% of the project is not developed, you can repatriate the money. Answer is no, both are cumulative. You need to comply with both. Only if 3 years is over and 50% of the project is developed can you repatriate your funds. And FIPP recently rejected 2 applications. One is in Kakade British Realty Pune and other is in Aqua Realty Bangalore. In both the cases, 50% of the project was not completed as per the local standards, and FIPP said no, you've not complied with the conditions, therefore you cannot repatriate the funds. Can an investor sell to another non-resident or domestic investor during the 3 years lock-in? So company is not giving you a lock-in, somebody else is giving you a buyout. Answer is no, lock-in is both qua the company and qua the investor. So if you are the investor, you need to be married to the company for 3 years, you cannot exit even if the company does not buy back your shares. And that has also been in DLF Limitless and in Uppal Housing, where they wanted to give an exit via domestic in DLF, and in Uppal Housing there was a foreign to foreign transfer. FIPP did not permit it. But in Sugam Vanijya, in Dhanlakshmi Holdings and Mantri Constellations, all 3 cases it was a group transfer. So one of the Mauritian entities of the NR investor invested, he wanted to transfer it to another Cypriot or a Mauritian company within the same group. FIPP permitted it because although within the lock-in time, it was within the same group, not going outside the group. So on a case-by-case basis, FIPP has been permitting, but generally if it's to an outsider, they are not going to be allowed.
Just to supplement, I think this group transfer is something which has been observed even in the old FIPP cases under certain other sectors. So they actually go by the lock-in by the investor himself, and NR to NR exit will not be possible. So there are other precedents in certain other sectors as well in the past.
Okay, the next question is 4.4. Will I again have a different series?
Alright, so under notification 1, it refers to a rigor under notification 1 with respect to person resident outside India making investment in any company, partnership firm, proprietary which is engaged or proposed to engage in real estate business. Again, before I just go to the query, there is one fundamental question here is that because the notification 1, permissible capital account transaction, it says save as otherwise provided in the Act, rules and regulations. That means the RBI has, apart from notification 1, went on to enact other provisions like FEMA 20 and other FEMA notification which actually govern various capital account transactions. So a standalone rigor in FEMA 1 itself does not mean anything. You have to actually go to the relevant notification and see if the necessary permission has been given vis-a-vis that particular investor and vis-a-vis that particular activity. So that's the first thing I would like to say, and then let's go to the queries. Can a non-resident invest in a company proposing to acquire commercial properties ultimately to give them on a long-term lease? Now, on many occasions, formally as well as informally, the DIPP has clarified that if you are just acquiring a property and giving it on lease, then it's a real estate business. Okay, because you are either not constructing them or not developing them. And the answer is even Now that particular type of activity is prohibited under the relevant regulation for the proprietary firm, partnership firm, but also for the NRI on the non-repatriation basis. So at least the way it seems is not because of notification 1, but because of even the subsequent notification, putting a restriction on the type of activities to be carried out by NRI. This type of activity should not be permissible. And would the answer be different if he wants to make the investment on non-repatriation basis? Even on the schedule 4 of FEMA 20, there is a restriction on NRI carrying out real estate activity. So I think that restriction will continue, and he will not be allowed to do a pure leasing, in that sense. Unless it's a personal investment, he has just invested like a capital asset, and it's a one-off lease that he's making, like a personal investment under the immovable property regulation. If he wants to carry it out like a business or in a company, that would not be permissible. So I don't think I've read the question. Can a non-resident invest in a company proposing to acquire commercial properties ultimately to give them a long-term lease? The answer is no, because that's a real estate activity not permitted. Would the answer be different? He wants to make an investment on non-repatriation basis. Okay. Now, I believe if he wants to make the investment in the Indian company on non-repatriation basis, if I read on it that way, that's the way to read it, right? So I think even under the non-repatriation schedule 4, there is a restriction on non-resident, and there are certain sectors which are prohibited. Even real estate is one of the sectors which is prohibited over there. And also, let me just fundamentally touch upon one more issue here. It is a principle that we have been carrying forth, may not be subscribed to many law firms and other advisors, is that ultimately when you look at the non-repatriation schedule, essentially would you look at overriding the sectoral policy under the FDI guidelines? Because, for example, if that view you would like to take, perhaps the NRI can even carry on something like betting, gambling, retail trading. I mean, there is no stopping there. You probably want to take that view. Many years back, at least when the FIPP and the DIPP were very active in giving the clarification, and there were several questions on the bulletin board where many people had raised this specific question as to whether the NRI non-repatriation basis could extend to sectors where FDI was prohibited. And the government very unequivocally said over there that no, it should not be permitted. So at least the view that seems to be emerging is that, and of course, unfortunately, the legal edifice of the law is not the very same way, because the FDI policy says that the FEMA is the statute. So if you look at the statute on a standalone basis, there is no legal like that. But if you look at the substance of what the government intends, perhaps the better view is from a government perspective or the regulator's perspective is that if there is a prohibition in the FDI policy, then that rigor perhaps needs to be read including in the Schedule 4. And in fact, I did mention this in my yesterday's presentation, that there has been a lot of discussion going around whether this Schedule 4 itself should continue in the FEMA 20 in the current form that it is, because it has created a lot of heartburns and a lot of people have actually done a back entry into many other regulations, and many of the cases are fairly well known as well. So I think the fundamental question that we need to answer is the Schedule 4 something which overrides the policy, or is the policy only married to Schedule 1 and the FEMA 20? Or is the schedule that has to be read throughout all the schedules of FEMA 20? And I think that would depend on the risk appetite of the investor as well. To a certain extent, at least we have been quite conservative in our approach, and we have practically guided not to venture into anything unless somebody wants to seek a specific clarification and then go ahead and do it on that basis. I hope that answers the question. Yeah. Construction of apartment for leasing the space. So the issue is, how would you construct the apartment? Typically you would have to be a developer. How would you construct the apartment? I mean, are you an individual? If you construct one apartment for yourself, and if you are taking rent, that's fine. If the Indian company, again, I think the question is a bit unclear. Construction of apartment for leasing the space, is it by the NRI or is it by the company?
Company. Investment in the company. So, and then leasing was permitted.
Correct. So that means in simple it is not acting like a developer under Press Note 2 of 2005. That's correct. That's what it would mean. If that's what it would mean, then at least my view is it will technically enter onto a real estate activity, perhaps not permitted.
No, Shabir bhai, what he is asking is that instead as a developer I have two options, sell or lease. Now I don't go for the sale model, I go for the lease model. So then what happens?
Okay, if it's a pure lease, that is permitted. I don't see that as an issue, because once you have complied with the provisions of the FDI policy, there is no restriction on the sale. Because I think the policy, if I remember correctly, uses the word transfer, the plot, and a couple of other words that are used. So there is no, in my view, embargo on lease versus sale. You are allowed to either lease the property or sell the property. That is up to you. There is no restriction, at least to the best of my knowledge, on that.
Now, here, while I agree with Shabir Bhai, RBI has wrongly, in some cases,